Yeah, hello everyone. Yeah, very good morning. Hope you guys are able to hear me. Okay, so just we can wait for 1 or 2 minutes and we can start the session. Yeah, hello everyone. Yeah, friends. So very good morning to everyone once again. Okay, so thanks for showing this much of an interest in option basic webs option basic trading trainings. Okay, so here we'll be going to have a look at what is put option, what is call option, and what is option greeks, all those basic level of training this will be. Okay, so I'll be going slow and steady. Okay, so hope you guys will be uh, hope you guys will be getting that because of if I go slow. Okay. Option greeks, all those basic level. Okay, so if you guys are watching our um YouTube channel for the first time, then you guys can just click on the like button, okay, and you guys can subscribe to our channel. Okay, so if you guys have look at, we'll be uploading a lot many videos related to an option strategies as well as in multiple option adjustments as well. Okay, so I'd request you guys to go through all my previous videos, so which will also will help you people to uh, get some knowledge about an options. Okay, and yeah, so this is my Twitter ID. Okay, so at rajamurgan 44, and if you guys are using an Twitter, you guys can follow me, so where we'll be posting lot many education related contents. Okay, so before we start, there is a disclaimer. Okay, so this is only purely for an educational purpose, and this is not any recommendations or anything else related to an option tradings. Okay, yeah, so we'll be starting our option webinar now. Okay, so option trading's history in an Indian market. Okay, so when the options have been started and what is the purpose of that, so all those things, these are all the history of an option tradings. Okay, so in India, like so exchanges have been introduced in options on June 4th, 2001. Okay, so on June 4 2001, the initial option tradings have been started only with an indexes. Okay, so suppose that from the 2nd July onwards, the individual stock option tradings also have been introduced. Okay, so right now if you look at the average volumes in trading segments, okay, so the 80 percentage of the derivative trades are happened only in an option and not in the futures. Okay, so most of the volumes traded in an Indian market or purely from 80% of the trades are happens only in an option, and balance 20% will happen in a futures. Okay, so options have a very good liquidity comparing to an comparatively to one futures. Okay, and also like if you look at the NSE exchanges, right? So NSE, which is an national stock exchange. Okay, so this is an world's largest exchange for a derivative trading in terms of a volume. Okay, so the more number of an trade happens in NSE for a derivative trading. So, okay, so this is an history of an option tradings. Okay, so right now we have like a good amount of stocks and indexes. Okay, so mainly the Nifty and Bank Nifty will be having a good amount of liquidity in options volume. Okay, so the advantage of an option trading. Okay, so the first advantage of an option trading is leverage. Okay, so even if you have a very limited capital, let's say just a 5,000 or 10,000 rupees, you can even start with an option trading. Okay, so that is the main advantage I would say for an option tradings. Okay, if you see in the leverage, let's say for example option trading requires a little amount to start with. Okay, so for example, if the share price, the particular stock price is trading at the price of 150. Okay, so for the stock which is trading at the 150, to for that if you want to buy the 1000 shares, you will require a capital of 1.5 lakh. Okay, so but if you are going to do the same thing in an option, their amount required will be like will comes around like 5,000 or 10,000 only. Okay, so uh, you can buy those kind of fund shares, so kind of 1000 shares which is trading at the 150 rupees with just 1000 rupees. Okay, so if tomorrow let's say from this 150 rupees if the stock is moving to 200 rupees, okay, so here with the capital of 1.5 lakh you are going to make a 50 rupees 50 rupees as a profit for the 1000 shares, but the same thing you are going to achieve in your option buying as well. Okay, so if you are doing an option trading, and let's say for example with the capital of same 10,000 rupees you are going to make 50 rupees as a profit for each shares. Okay, so this is an very good advantage of an option trading. So, okay, so where you can leverage your trades. Okay, so then the next thing is flexibility. Okay, so if in future trading, if say if you're doing a trade in the future trading, then the stock or the index, whatever the option you are entering, that should move either upside or downside as per your direction, only then you are going to make a profit. Let's say for example, if a stock is trading at 150 rupees as per the previous example. Okay, so if the stock is trading at 150 rupees, and if you are buying an future, right, only if the stock moves above 150, only then you are going to get the profit from the future tradings. Okay, or if you are on the sell side, and only if the stock is going to move below 150, only then you are going to make a profit in futures, right? But in the options, if you look at, you can make a profit even if the stock is moving higher, or if the stock is moving lower, or if the stock is trading sideways, means like the particular stock is not moving anywhere, and if it is trading flat at 150, okay, even that time you can make a profit. Or even if the stock is trading, its underlying particular stocks volatility increases or decreases. Okay, so if you're a buyer, then if there is an volatility increase happens after you enter the trade, you're going to get the profit. Or if the volatility is going to get decreased once you entered as an option selling, then also you're going to get the profit even though the particular stock is not at all moving anywhere. Okay, so this is about an advantage of an option tradings, I would say. Also, even after entering into one trade, you can do one multiple adjustments with your trades, and with that adjustment as well you can start earning money. Okay, so which means that let's say for example you are bullish on particular stock and you have entered. Okay, so after entering, if the stock start reversed, okay, you can do some adjustment so that you can come out of the trade with a profit or without any loss even at last, at least at the worst cases. Okay, so this is about an advantage of an option tradings. Okay, so now what is options? Okay, so this session I am assuming that you guys have a little bit of knowledge. Okay, so from the very scratch we'll be starting, and we'll be moving one by one, step by step, so that all people can uh, get a knowledge on that. Okay, so we have a two type of an options available. Okay, so one is call option and one is put option. Okay, so traders can either buy or sell, or you can do both buy and sell for the above mentioned two options. Okay, so we can combine call option and put options for both buy and sell. Okay, so by doing these things we'll be going to get a option strategies. Okay, so if you're going to do multiple option, call option buy, call option sell, and put option buy, put option sells, right? So by combining these many things, right, we'll be going to create an option strategies. Okay, so this is where the option strategies comes. Okay, so if you look at the option strategies, right, so we'll be having more number of an option strategies available. Let's say I read somewhere like around 400 option strategies are available in a public forum itself. Okay, so apart from that, even there are lot many option strategies which are not available in the public, and some people used to trade for their own purposes. Okay, so this is about an option strategies. Okay, so again, by doing the right adjustments, we can either minimize our loss or we can increase our profit as well. Okay, so let's say for example, if you guys have a look at an piano keyboard, right? So we'll be having only an 8 different sounds. Okay, but with the help of that 8 different sounds, we can be able to make a lot many musics as an outcome, right? So same like we can combine this call option and the put option for both buy and sell, and we can create a lot many option strategies using this. Okay, so this is about an option strategies. Okay, so now we'll look at an commonly used option trading terms. Okay, across. So if you look at an Twitter or wherever, the blog or YouTube channel or wherever it is, okay, so you will become to know that there is a lot many commonly used terms. Okay, so the first thing is underlying. Okay, so underlying is nothing but it is the stock. For example, let's say I'll take an example of an Reliance. Okay, so if you're doing an Reliance option strategy, then the Reliance stock is an underlying for that particular options. Okay, so here let's say option move based on its underlying. Okay, so if you're doing any trade in any of the options, right, that option price movement will happen based on its underlying stocks. Okay, so the Nifty options will move based on the Nifty's performance. Okay, so if the Nifty is moving upside, based on that the Nifty options will either move up or move down. So, or if the Nifty is moving on the downside, the same on based on the Nifty's movement, the Nifty's option will move either up or down. Okay, so the options will move only based on its underlying stocks. Okay, so the strike price, next one. Okay, so strike price is nothing but it is a predefined price. Okay, so it will have an strike prices in the every predefined price based on its stock options prices. Okay, so in that place, both call option and put option buyers or sellers will do the trade respectively. Okay, so let's say for example now let's assume that Nifty is having an Nifty's underlying price is at 13,500. Okay, if you look at the Nifty strike price is available for every 50 points. Okay, so 13,500, 13,550, 600, 650, 700, for each 50 points there will be an option strike price available where the buyer and seller of both call and put option traders can do their own respective trades. Okay, so for each strike prices there will be an call and put options respectively available respectively. Okay, so for if you look at the 13,500, there will be 13,500 call option and as well as the 13,500 put options will be available. Okay, and there is something called expiry date. Okay, so what is an expiry date? So if you are entering into an option trade, okay, so there will be an expiry date where you have to close your existing trade. Okay, whatever you are doing in options. Okay, so that will happen on every last Thursday of every Thursday of an every month. Okay, so that is for an stock options, and so that is for an every Thursday of a month, last Thursday of every month there will be an expiry happens. Okay, so this is for an each and every stocks. Okay, and you can see the next 3-month options will be available for you to trade for each and every stocks. Okay, so right now we are in the December. Okay, so you can do an stock option trade in December month or January or in February. Okay, so you can do a trade for the next 3 months expiry. Okay, so whenever the stock whenever we get the current month expiry, then what will happen is the very next month contract will be opened. Okay, so in this case, for example, if we are moving to an December 31st, which is an expiry of the current month, then after that what will happen is we can able to see March month contract as well for the trading. Okay, and you have to close your options on the expiry date. Okay, so every Nifty on Bank Nifty indexes are cash settled. Okay, and you can hold it till the expiry time. Okay, so if the expiry happens, what will happen is whatever the profit or loss you have, so that will be cash settled. Okay, so if you are doing an options in a stock options, okay, so stock options are you have to take in delivery of the stock, so that we will be going to have a look at in the next upcoming slides. Okay, so this is about an expiry date. Okay, so for if you are going to trade in the indexes, expiries will be for every week Thursday. Okay, so we'll be having an weekly option as well as a monthly expiry as well as a weekly expiry. Okay, so this is about an expiry date. And if you look at an option premium, okay, so what is an option premium? The price which an option buyer is ready to pay for buying an option, and the price which the option seller is ready to sell the options. Okay, so for each and every strike prices there will be a predefined option prices. Okay, so that will keep on changed based on an underlying prices. Okay, so if the stock price is moving 1 rupee, on the upside, let's say for example if the stock is having a stock price of 100 rupees, and if you look at the stock option premium for 100 strike price call option, it will be somewhere around 5 rupees or 10 rupees. Okay, so as per the multiple scenarios, the option premiums will be there. Okay, so this is an option premium is nothing but the buyer and seller is ready to do the trade for the particular strike price. Okay, so for let's we'll be having in multiple strike prices, and premium will be in a different prices for each and every strike prices. Okay, so all the strike price will never have a same premiums. Okay, so then we have something called in the money option. Okay, so in the money option is nothing but call option in the money will be like the strike prices which are all trading lower than the underlying assets. So for example in the nifty, so let's say an example of a nifty is trading at the level of 13,500. Okay, so if nifty is trading at 13,500 and whatever the strike price is available below 13,500, okay, let's say 13,400, 13,300, 13,200, all the strike prices available below 13,500 on the call side belongs to one call option in the money. Okay, and all the strike prices trading higher than the underlying strike price. Okay, so for example 13,600, 700, 800, or 14,000, 15,000, all the strike prices will be in the money put options. Okay, so this is about an in the money. If you look at an at the money, right, the strike prices which is equal to or nearby an underlying stock price. Okay, so let's say 13,500 is an Nifty's current price, then 13,500 call option and 13,500 put option or an at the money. Okay, so this is about an at the money options. Okay, the stock price, the strike price which is having trading near to an underlying stock price, so that will be an at the money option. Okay, so this will be same for both call option and put option. Okay, then we have something called out the money. Okay, so that is named as an OTM. Okay, so OTM is nothing but if the stock price which is strike price which is available higher than the underlying price on the call option is an call option OTM, and the strike price which is trading lower than the stock price, this is named as an put option OTM. Okay, so the strike price which is available above the higher level will be OTM for call option, and below the strike price will be an OTM put option. Okay, so this is about an option trading jargons. Okay, so we have seen what is underlying strike price, expiry date, option premium, in the money option, at the money option, and out the money options. Okay, so now we'll just look at an option chain example. Okay, so this is an example of an ITC stock. Okay, so here you can see that, so this is an underlying price. Okay, so the underlying strike price of an ITC is 206.85. Okay, so this is an underlying price. Okay, so for each and every option chain you can come to know about an underlying strike prices, underlying price of the particular stock. Okay, after that here you can see, so this is an strike price of this particular stock. Okay, so you can see ITC is at 206. Okay, we can see that 205, 202.5, 200, for every 2.5 rupees there is an strike price for this particular stock. Okay, so this is an strike price, and whatever the strike price whatever the data available on the left side of a strike price related to one call option, and the data available on the right side belongs to one put options. Okay, so here we can see that, so this is an ATM put option. Okay, so ATM options, so the left side belongs to one ATM call option, and the right side belongs to one ATM put option. Okay, so here we can see 206.85 is the price of that underlying stock. So the very nearest strike price is an 205. Okay, so 205 is an ATM option. Okay, so which is an at the money. Here we can see the LTP price. Okay, so this is an premium. Okay, so if any of the trader wants to buy this 205 strike price call option of an ITC, then they have to buy with they have to buy the pay the premium, which is 8.4 rupees. Okay, and if any trader is going or willing to buy the put option, then they have to pay the premium of 6.80. Okay, so which is an premium for the 205 put options. Okay, so this is about an at the money. Okay, so here you can see that, so this is an in the money call option. The strike price whatever is trading below the strike below the underlying stock price. Okay, so these are all belongs to an in the money call option. And if you look at the right side, right, so these are all the strike price which is trading below the underlying stocks, and this is an put option, right? So this is an OTM put option, which is an out the money put option. And if you look at the downside on the left hand side, right, so this is an OTM call option. Okay, so which means that the strike price which is trading above the current stock price. Okay, which means that these are all out the money call option. And if you look at the right side bottom here, this is an in the money put options. Okay, so these are all the strike price which is trading above the current strike stock price level. Okay, so these are all the in the money put options. Okay, so now options. So hope you guys are getting some idea about what is an in the money, what is at the money, and what is out the money, and what how to define that by looking into an option chain data. Okay, so this is an option chain. Okay, so now, so again here you can see that, so this is an expiry date. Here you can come to know the expiry date for that particular stock. Okay, so here, so this is an older data. Okay, so here you can see this is in 30th July 2020 expiry. Okay, so if you guys look at the current live data, right, so that will be, you have to look at the expiry date of 31st December. Okay, so now we can look at an option. Okay, so trader can either buy or sell the option with predetermined lot size. Okay, so for each and every stock there is a predetermined lot size. Okay, so you cannot simply go and buy the option with one quantity. Okay, so that is an that will have a predetermined lot size only. You can either buy or sell. Okay, so for example, one lot of a nifty option is 75. Okay, so if you want to buy an any of the option, you have to buy in the multiply of 75 only. Okay, so if you are willing to buy one lot, you can buy it, or if you want to buy two lot, you can buy it as an 150 quantity. Okay, but you cannot, let's say you want to buy only one share, you cannot buy it. Okay, so there will be a predetermined lot size available for each and every stocks. Okay, so then index options are always in cash settle, so you can hold it till the day of an expiry. Okay, but if you look at the stock options we need to take the delivery, or if you are holding till the time of an expiry. Okay, so broker, what will broker do? Broker will ask us to load some extra margin. Okay, so if you are not providing any extra margins, then what will happen is we have to pay some penalty to one exchanges because of not having a proper margin available for our holding positions. Okay, so the maximum time we can hold a stock in the current expiry is we can hold it till the Monday of an expiry week. Okay, so beyond that this margin requirement will start increased. Okay, so you cannot hold it beyond that. Okay, so this is how the stock options work for both stock and indexes. Okay, so you can hold it till the time of an expiry, and for the stock options you cannot hold it till the time of expiry until or unless you are ready to take delivery or to provide the delivery whatever the stock you are holding. Okay, so if you are having an extra margin, then you can hold it till the time of an expiry. If not, if you are doing just simply for a trading purpose, then you should close your stock option trading by the time of on Monday on the expiry week. Okay, so option premium. Okay, so you guys might wonder on what basis the option premiums are calculated, right? So option premiums will be calculated on based on lot many steps. Okay, so that is like how many days are available for an expiry, or the days available for an expiry, or based on the volatility of a particular stocks. All those things uh, will be used for an option premiums. Okay, so option premium will contain intrinsic value as well as a time value. Okay, so what is an intrinsic value? So to find out an intrinsic value, you have to calculate the spot price minus strike price. Okay, so for example, uh, So for example, Reliance is trading at the price of 2000 rupees. Okay, and if you look at the 1900 call option, okay, so which is an in the money call option, right? Let's say it is trading at 120 rupees. Okay, so then what will happen is the intrinsic value of this 1900 call option is just 100 rupees, and 20 rupees will be in time value. Okay, so when the expiry gets nearby, this 20 rupees will start fade out. Okay, and if the stock is expiring at 2000 rupees, then the 1900 call option will have only the premium of 100 rupees by the time of an expiry. Okay, so this is about an intrinsic value. Okay, so this 100 rupees is an intrinsic value, which means that the differences between stock price minus in strike prices. Okay, so this is for an call option calculation. And if you want to look at an intrinsic value of a put option, then you have to subtract the spot price from strike price. Okay, so same example. Okay, so for example, Reliance is trading at the price of a 2000, and 2100 put option is trading at 130 rupees. Then the intrinsic value of 2100 put option here is only 100, and 30 rupees will be in time value. Okay, so this 30 rupees, what will happen whenever the expiry gets neared, this 30 rupees will start decayed, and the 30 rupees will be moved to zero. Okay, so only this put option of 2000 will have 100 rupees on the time of an expiry if the stock is trading at 2000. Okay, so let's say for example the stock moved down and it is trading at 1900, then the 2100's put option will be having an intrinsic value of 200. Okay, so the strike price of the 2100 put option will have an option premium of 200 by the time of an expiry if the stock is trading at 1900. Okay, so this is about an intrinsic value calculations. Okay, and if you may see that 2100 see, so in this same example, right, so stock is trading at 2000 and 2100 will not have an intrinsic value at all. Okay, so in that case, so this is an OTM call option. Okay, so what will happen is the OTM call option will have a premium of around 10 rupees or something else. Okay, you may see that 2100. Okay, so this OTM call option will have a premium of 10 rupees, and if the stock doesn't move above 2100 by the time of an expiry, then what will happen is the person who has sold this 2100 call option will get the profit of 10 rupees, because this is just purely in time value. So this will get decayed and will be having only an 2100 call option will expire as zero. Okay, so you might have heard about a theory that most of the options will expire worthless. Okay, so which means this is the case, all the OTM options will expire worthless. Okay, and if you look at the OTM options expire worthless, which means that on the expiry day, if the stock price doesn't reach 2100 or trading below 2100, this 2100 call option will be uh, expired worthless, so the trader will be getting the profit. Okay, so if you guys have any doubts, you can just uh, chat. I hope the chat window is open. You guys can just ping me. So I'll be just waiting for 2 minutes so that we can just have a Q&A for the things whatever we have seen till now. So any doubts, or shall we proceed? Okay, and can you guys click on that like button? So if you guys have liked our session till now, I'll also take a sip of water until that. Yeah. Okay. I'll be moving to an next slide now. Okay. So this is so someone asked about an explaining how to analyze an OIIV, right? So I'll be covering in a little bit basics of an option Greeks. Okay. So the this particular session is only purely for an basics. Okay. So we might have an some other webinar if time permits in the future time. Okay. So where we can look at a deep option strategies. Okay, sure, thanks for that. Okay, so I'm expecting some like buttons. I can see that like around 53 people, like around 60 people are keep on watching. Okay, so just see how to know option buyers or sellers are more. Okay, so if you look at the trade will doesn't happen without a buyer or seller. Okay, so which means if there is an one trade happens, which means there will be both buy and sell. Okay, so we cannot come to a conclusion only option buyers are there or only option sellers are there. Without these two peoples having a trade, uh, so we cannot uh, the trade doesn't happen. Okay, so that is an actual thing. Okay, so based on the option price movements, all those things, we can assume that more people are on the buy side or the sell side. Okay, so that for that we need to have a little bit of an extra things. Okay, so if time permits I will cover that in the same session, or if not we can have it as a different session in the future time. Okay, so yeah, can I show some more example of an in the money, at the money, in OTM? Okay, see, I'll open you, I'll be opening an yeah, I'll open an option chain of a Nifty and I'll show you that. Okay, so that you guys can have a look at. Okay, so this is an option chain page. This is an option chain page of an Nifty. Okay, so I'll just choose an expiry as 31st December. Okay, so here we can see that. So this is an underlying stock price. So this is an expiry date. Okay, so here we can see there are a lot many expiries available because like Nifty will have an weekly expiries as well. Okay, so here if you look at, okay, so whatever the thing on the left side, see in the simple term, if you want to remember, right, the yellow color will be an in the money options all the time. Okay, so if you look at this yellow color, right, yellow color background in the call option, so this is an in the money call option, and yellow color on the right side, this is an in the money put option, and white color will be an out the money, and white color on the right side will be an out the money put options. Okay, so here we can see, so this is an put. Okay, so here you can see the LTP prices, right? So for each and every strike prices, so these are all the prices where this particular strike price premiums are available for now. Okay, so you can see always in the money options will have a higher premiums, and at the money will have a nominal premiums, and out the money will have a lesser premiums. Okay, so here you can see that right now the price is around 13,750, and if you look at 14,600 or 14,000 premiums, right, here you can see that it is in 53. Okay, so this 53 will be purely in time value. If the market doesn't reach to 14,000, what will happen by the time of an expiry? This 14,000 call option will expire worthless. Okay, so the premium of this will be zero. Okay, so if you look at the same side for the 14,000 put option, right, so this premium is available, 14,000 put option is available at the premium of 286.80. Okay, so which means, let's say for example Nifty expires at the level of 14,000. Okay, what will happen is this premium will goes to zero. Okay, or let's say for example Nifty is expiring at 13,900, what will happen, the 14,000 put options premium will be 100. Okay, so or let's say if Nifty is going to is more bullish, and if it moves to 14,100, the 14,000 put option will become an OTM, which is out the money. Okay, and what will happen is this 14,000 put options will become zero, because since it's an OTM now. Okay, so OTM if the market moves to 14,100. Okay, because like this whatever the strike price below this below the spot price will be considered as an OTM for an put option. Okay, so in that case this strike price will expire as an worthless. Okay, yes, so does the price differ from weekly expiry and the monthly expiry? Is yes. Okay, so because the This option premium will contain the time value as well as an intrinsic value, right? So let's say I'll show you an example. Okay, if you look at the 14,000 call option, it is trading in 53.10 for a monthly contract, right? So if you look at 24th expiry, the time for an expiry is very lesser, so there won't be much time value available. Okay, so if you look at the 14,000 call option, which is available at the price of 13.11 only. Okay, so you can see the differences, right? So if you look for a very far OTM, sorry, very far month, okay, I will show you an example of a 28th Jan. Okay, so if you look at the 28th Jan, same 14,000 call option, here you can see that LTP is 233. Okay, so now you can see the entire 233 rupees is a time value only, because we have a more number of time, so we have a more number of a time value. Okay, so if the expiry gets neared, what will happen is the time value will start decay. Okay, so that is the reason you can see the differences, right? So in the current week expiry, the same 14,000 call option is trading at 13 rupees, and the current month expiry, it is trading at 53 rupees. And you can see that the very far month, which is in January next month contract, you can see the 14,000 is available at 233. Okay, even if you look at the very far month, so let's say I'll show an example of March. Okay, so if you look at the March, it will be somewhere around 400 plus or something. Okay, so yeah, you can see that by the 14,000 call option, you can see that it is having an LTP of 432. Okay, yeah, yeah, that's what I explained, right? So in the money and out the money, all those things. Okay, so this is about an option premiums. Okay, so now let's enter into an call option buying. So when you have to buy call option, or when you have to sell call option, and when you have to buy put option, and when you have to sell the put options. Okay, so these things we'll be going to have a look at now. Okay, so call option buying. Okay, so if you're an option buyer, then we need to pay only the premium to buy an option. Okay, so for example, okay, so let's say for example 13,500 call option is trading at the price of 100. Let's assume that. Okay, so this is an example. Okay, so if you are seeing that if you see that 13,500 is trading at the price of 100. Okay, so then how much the call option buyer have to pay for entering into this trade? Okay, so the lot size of an Nifty is 75. Okay, so what the trader have to do is 100 into 75, which is 7,500. Okay, so the option buyer only needs to pay this premium as their as the margin to enter into this trade. Okay, so because whatever happens, this trader is not going to lose more than this 7,500. Okay, so let's say if market is going, so you have entered as in 13,500, assuming that market is bullish, and if the market goes upside, you're going to earn some money. Okay, so you have spent money. So right now the premium is 100 rupees. Okay, so tomorrow, let's say for example, market started falling down, starts move down, and let's say market moves to 13,000. Okay, so in this case what will happen, this 100 rupees 13,500 call option will become as an OTM, which is out the money call option. Okay, so after that, so if the if the Nifty expire, if this call option expires as an out the money, then this premium will goes to zero. Okay, so in that case the option buyer of this 13,500 call will be going to lose only the 7,500. Okay, so even wherever the market goes. Okay, so if there is a sudden crash happens and market moves to 12,000 or wherever it is. Okay, so in this case what will happen, this premium will only goes to zero and not beyond that. Okay, so in this case the option buyer will lose only 7,500. Okay, not higher than that. Okay, so and the margin requirement also will be same. Okay, only the 7,500 is going to pay, and if something bad happens, he is going to lose this entire 7,500 only, and not more than that. Okay, as a trader he bought 13,500 at 100 rupees, so trader will get profit only if Nifty close above 13,600. Okay, because he have paid 100 rupees as an initial payment already. Okay, so if Nifty is expiring at 13,600, then what will happen, this 13,500 call option will have only the premium of 100 rupees and not more than that. Okay, so in that case what will happen is the trader will not able to earn anything. Okay, so his profit and loss will be zero. Okay, so if Nifty is closing at 13,700, then his profit will be 100 rupees, because this the 13500's premium will be 100. Or if market moves to 14,000, okay, 14,000 with a below before this expiry, okay, what will happen, this 13,500 call option will be trading at the price of an 400, sorry, 500 rupees, okay, so he'll be getting the profit of 400. Okay, so with the capital of 7,500, he can even earn twice or thrice the amount, okay, twice or thrice the time of a profit, time as a profit. Okay, so this is an very good advantage of an option buying. Okay, so you can multiply your amount if your trade goes right. Okay, so if you're an option buyer, then you will have a limited loss and unlimited profit. Okay, so let's say there is something good happens and nifty rallying, nifty starts rallying 1,000 points on the upside. Okay, so only with just an investment of 100 rupees you are going to earn 900 rupees as your profit, correct? So by this way option buyings will give you an unlimited profit wherever the market starts moving. Okay, you will be going to get the profit as per the market's movement. Okay, so if market move to 14,000, okay, so you will be getting and 400 rupees as your premium. So with the margin of 7,500 you can able to earn 30,000 rupees as a profit. Okay, so in case and at worst case nifty crashes and move down, let's say same like in February March market move to 7,500, 8,000, or even if it goes to 5,000, 4,000, wherever it is, the trader who bought this 13,500 call option will not lose more than 7,500 rupees wherever the market goes. Okay, so he is going to lose only an option premium whatever he have paid. Okay, so so this is about an option buying. Okay, so let's say let's look at an option buying's payoff graph. Okay, so this is an option buying payoff graph. Okay, so by the time of an expiry, what will happen if your trade goes wrong? So this is an medium line. Okay, so below above this it will be in the profit and below this it will be in the loss. Okay, so let's assume that you are an option call option buyer. Okay, so once you have bought this, so if the stock started falling, your loss will be limited. Okay, so it will not go beyond your option premium whichever you spend for buying that. Okay, so this is a straight line. Okay, so whenever the market hits, so this is in strike prices. Okay, strike price or the option prices at the different levels. Okay, so you will be not going to lose much more than that. Okay, but if the stock price starts moving upside and if your trade goes right, okay, so if you are at 105 rupees, you will be in this profit. Or if it is again moving 110, 120 or wherever, your option payoff graph will go straight away on the upside. Okay, so if it starts moving upside. Okay, so this is about an call option buying. Okay, so let's look at an call option selling. Okay, so call option seller will have an exact opposite view of an call option buyer. Okay, so this is how the market exists. Okay, so if someone is bullish on the market, and there will be someone who is bearish on the market as well. Okay, so only because of that there will be an buyer and seller who comes to and will be there in the market. Okay, and the trade will happen due to that, only due to the opposite views of multiple peoples. Okay, so if you look at yeah, throw some light on the implied volatility. Yes, I'll show that will be coming in the upcoming slides. Okay, so if a option buyer, so option selling will have an exact opposite payoff graph of an option buying. Okay, so if an option buyer have a limited loss which is in premium paid, then where the option seller will have a limited profit. Okay, so which is in premium received. So in the above example, if the option buyer of 13,500 is having a loss of 7,500, then the option seller of 13,500 will have the maximum profit of 7,500 only. Okay, so option buyer will have an unlimited profit, so the option seller will have a unlimited losses. Okay, so in this case, let's say for example, if whatever the profit is made by an option buyer, that will be the loss of an option seller. Okay, or whatever the profit made by option seller, that will be a loss of an option buyer. Okay, so there will be a break-even point. Okay, so break-even point is the place where option buyer starts making money, and at the same level option sellers will start making loss. Okay, so if you look at So this is an break-even level. Okay, so in our previous example, the 13,500 call option, right? So if you look at the 13,500, we have bought at 100 rupees, right? So for the option buyer, 13,600 will be the break-even for an option buyer. So after that, the option buyer is going to make a profit, and the below that the option sellers will be going to make a profit. Okay, so that is the break even level for both option buyer and as well as an option seller. Okay, so above that break even level of 13,600, option buyer will start making money, and after 13,600, that break even level, option seller will start losing money. Okay, so that is about an break even level. Okay, so option sellers will lose money only if stock moves more than the premium he received. Okay, so for example, the 13,500 call option seller, right? So he collected the option premium of 100 rupees. Okay, so the option seller will lose money only if Nifty moves above 13,600. Okay, so even if the stock is going to, if the Nifty is going to stay flat, what will happen? Option seller is going to make some money. Okay, so if Nifty expires at 13,550, then what will happen is option sellers will get the profit of 50 rupees. Okay, so hence here he received the 100 rupees premium. Okay, since uh, Nifty is expiring at 13,550, the option premium, which is an intrinsic value of this 13,500, will be only 50 rupees. Okay, so since he sold at 100 rupees, what will happen is he will be going to get the profit of 50 rupees. Okay, so this 13,500 call option will expire at 50 rupees. Okay, so he will be going to get the profit of extra 50 rupees as his premium, which is a profit. Okay, but if you look at an option sellings, the margin requirement for option selling will be higher compared to an option buying, as because in option buying, if you see, the losses will be limited. Okay, so he'll be not going to lose anything more than the premium which he have spent for buying that, right? So he's not going to lose more than that. But in the option seller case, if market moves to 14,000, let's say, okay, what will happen? This 13,500 call option will be having the premium of 500 rupees. Okay, in that case, this option seller will be making the loss of 400 rupees. Okay, so which is in 30,000 rupees. Okay, so that is the case, the margin requirement for an option sellers will be higher. Okay, so this is about an option selling. So and how to calculate the break even point? Okay, so strike price plus premium. Okay, so in this case, the strike price is 13,500 and the premium which we collected is 100 rupees. Okay, so 13,500 plus 100, which is 13,600, will be our break even for an option seller. Okay, so that is the reason the option selling have a higher margin. Okay, so we'll be getting an maximum unlimited losses on the upside. Okay, so if you look at an payoff graph here, you can see that, so this is having an exact opposite of an buying call. Okay, so if market is trading below your strike price, or it started moving lower and lower, what will happen? You will be going to get the profit. Okay, so this is in zero, and above that it will be profit, and below that it will be in a loss. Okay, so what will happen is, here you can see that wherever the market hits, you'll be making the profit of 300, and above this level you can see that wherever the market starts moving upside, what will happen is you will be getting an unlimited losses. Okay, this line will keep on going moving down, so as per that. Okay, so this is about an call option and buying. Okay, so when to buy call option, or when to sell the call, I'll be covering in the upcoming slides. Okay, so till now, if you guys have any doubts, till now whatever we have seen, um, you guys can just open your chat and you can ping me here. So any doubts till this? So any doubts? Okay, so I'll be taking it as a no from you all. Okay, so put option buying. Okay, so if a trader thinks that stock will go down, then he will buy a put option. Okay, so to get the benefit from that. Okay, so if the trader is thinking that stock will move upside, he will be buying an call option, and if the trader is thinking that particular stock is going to move down, then he will be buying an put option. Okay, so the same like an option buying. In the call option, option buyer, put option buyer as well have to uh, pay only the premium whatever the option premium is available. Okay, so you have to pay the same premium to buy and put option as well. Okay, so here I have taken an example of an Reliance. Okay, okay, so Reliance is trading at 2000 rupees, and if the trader assume that Reliance will move down, then he will buy an 2000 put option at 50 rupees. Okay, so this is an assumption. Okay, so this is just an example I'm sharing here. Okay, so put option buyer of 2000. Okay, so he have to pay the premium of 50. Okay, so as 50 into the lot size of an Reliance. Okay, whatever the lot size. Okay, so you have to pay that. Okay, so if Reliance moves down, then the put option buyer will get the rights to sell Reliance at 2000 rupees. So let's say for example, if the stock starts moving downside, okay, and if the stock moves, let's assume for an example that you are holding an one lot equal amount of a share in your demat account. Okay, so you are worried that there is something bad is going to happen in the Reliance, and if something bad happens, you are not okay to uh, incur the losses. Okay, so you have to sell it at the 2000 rupees itself. So in this case, what you can do is you can just buy one put option at 2000 rupees at the premium of 50 rupees. Okay, so tomorrow, let's say for example, Reliance starts falling down to 1900 or 1800. What will happen is you will be going to get the loss in your demat holding shares, but you will be going to get the profit from your 2000 put option. Okay, so which will act as an insurance for your holding stocks. Okay, so if stocks closed at 1800 by the time of an expiry, what will happen is you will be going to get sell this Reliance at the price of an 2000 itself, because you have bought one put option here. Okay, so or even if you are not holding any stock at all, and if you are doing this only for the pure trading basis. Okay, so what will happen if the stock have been moved to 1800, then what will happen is this 2000 put option will be having a premium of 200. So you have spent 50 rupees already, and you will be getting the profit of 150 rupees as your profit. Okay, so which means that you will be getting 300% profit for the put option buying. Okay, so here if at worst case if the market start reversing and if the stock is trading about 2000, what will happen is you will be going to lose this 50 rupees whatever the premium you have spent to buy these put options. Okay, so this is the maximum loss you are going to get by buying these put options. Okay, so if you look at the payoff graph, so this is a payoff graph. Okay, so here we can see that put option buying. So if the stock is moving upside, what will happen is you will be going to get the limited losses. Okay, so your loss will not go beyond this level. Okay, so whatever the premium you spent. Okay, but if stock starts moving up, moving downside, right, so what will happen is so you will be going to get the profit as per the downfall. Okay, so something if any bad happens, and if stock crashes to 1000 or 1500 or wherever it is, as per the strike price, the difference between the underlying stock and the strike price, whatever the differences are there, you will be going to get the profit. Okay, so with the initial investment of 50 rupees, you are going to get the 100 or 150 or 200 if the stock starts falling down. Okay, so this is about an option put option buying. Okay, so same like put option seller. Okay, so the put option seller's view on the particular stock is bullish. Okay, so if he is bullish on the stock, so instead of buying and call option, he may also choose to sell and put option. Okay, so in the previous example we have seen uh, the trader bought 2000 put option at 50 rupees, right? So same way there is an opposite trader who will be selling 2000 put option at 50 rupees in bullish view. Okay, so if Reliance stay at 2000, then the put option seller will earn 50 rupees as a profit, and if the put option buyer will in the opposite side, the trader who bought the put option at 2000 put, right, so he will be losing 50 rupees. Okay, so if the trader is not sure about the trend, then what will happen is it is little bit makes sense to sell the options than buying options. Okay, so because in the option buying the stock should move 100% as per your view. Okay, so only then you will be going to make a profit in option buying. But if you are doing an option selling, even though the stock trades flat, or even there will be some break even, there will be some cushion for our break even. Okay, so the trader have bought this Reliance at the 2000 put, assuming that the stock is bullish, but even after some time there is something happens, and if the stock doesn't move and if it falls down to 1970 or 1950, right, till that he is not going to lose at all. Okay, so even if stock starts falling below 1950, only then the trader should take some action. Okay, so whether he can do some adjustment or he can come out of the trade with some stop losses whatever as per the risk capacity of a particular trader. Okay, so this is about an option put option selling. Okay, so any doubts till now? Yeah, so how to define that? So that is kind of a different topic. Okay, so this options session is purely for an basics. So if time permits after the sessions, I'll be covering that as well. Okay, so I'll cover how to look into an option change, all those things. So if time permits. Okay, so any doubts till now for call option buying selling or put option buying selling? Okay, okay. So I'll be moving to a next slide. Okay, so this is an payoff graph of an option selling. Okay, so if you look at an option selling, put option selling, right? So if the market stays bullish, okay, so wherever the market moves on the upside, what will happen, the put option seller is going to make a profit. Okay, but if there is something bad happens and if the stock starts moving downside, okay, so the loss will keep on increase as per the downside movement. Okay, if the stock moves more down, your put option premium will start to increase, and since you are in seller there, okay, so you will be making in losses. Okay, so option buying or option selling, when you have to buy option or when you have to sell option. Okay, so if you are bullish, pure 100% bullish on any particular stock or index, okay, so you have to buy and call option. Okay, so in this case there will be a debit in your premium, which means that you'll be paying from your packet. Okay, so this is an debit strategy. Okay, so you have to buy call option if you are bullish, or if you are bullish, or you might think that the stock might consolidate or uh, stay flat for sometimes. Okay, so then in this case what you have to do, you have to sell put option. Okay, so if in this case if the stock moves bullish or flat, okay, it will make sense to sell a put option than buying and call option. Okay, and if you are on bearish on any stock or index, you have to buy a put option, or if you think the stock is bearish or it might stay flat, then it makes sense to sell call option. Okay, okay, so uh, this is about an option buying. You have to do option buy or option sell. Okay, so you guys can look into this tabular column. Okay, so if you are bullish, it makes sense to buy call option or sell put option, and if you are in bearish, you have to buy put option or sell call option. Okay, so if you are buying an option, then the market should move as per your own direction, at least beyond the PF, beyond the break even only you will be going to make an profit. Okay, if not, if you are an option seller in this case, even though if the stock trades flat, you will be going to make an profit here. Okay, so any doubts till now? Yeah, Thanks Milan Power for your compliment. Okay. So Abhishek, okay. So any good strategy you want to share for buying option? So for good strategy for buying option is simply a naked vanilla buy option only. Okay, so we have an multiple options. Okay, multiple buying side related as well. Okay, so but in those case you have to mix both buy and sell as well. Okay, so without mixing and buy and sell you cannot have a buying side strategy. Okay, so um, if you are in buying option, then it is simply a naked option only. Okay, or you can go for an spreads kind of an uh, put credit spread or call credit spreads or those kind of things. Sorry, debit spreads. Okay, so if time permits, I'll be sharing that as well for sure. Okay, so I'll be moving to an next slide now. Okay, so which is in the money, at the money, and out the money. Okay, strike price below ATM in call option is in the money, and strike price above ATM in call option is out the money. Okay, and strike price below ATM in the put option is out the money, and strike price below ATM in put option is in the money. Okay, so always in the money will have an higher premium as it contains both intrinsic value and time value. Okay, but out the money will be having a lesser premium as it contains only time value and no intrinsic value. Okay, so what is hedging is nothing but hedging is like if you are having an option sell, right? So option sellings will come with an unlimited losses. Okay, so you should maintain one buy. Let's say for example in the above example we have seen the 2000 put option, right? So if you are selling a 2000 put option, what you have to do is we doesn't know that something what will happen in the upcoming days if you are in the positional trades. Okay, so something bad happens if stock started crashing down very fastly, then the loss in your sold put option will be very huge. Okay, so in that case what you have to do is you have to buy one put option on the lower side. Okay, so that will have, what will happen is that will hedge your position, so without making an unlimited losses. So for example, you are selling 2000 put option, you can buy 19,900 put option. Okay, so 1900 put option you can buy it. Okay, so that will limit your losses. I'll show you in payoff graph in the future, post our session gets over. Okay. Okay, so now let's look into some basic things about an option Greeks. Okay, so you might have seen lot many tweets or a blog or YouTube's people start talking about an option Greeks, and you might have wondered what all these things. Okay, so option Greeks are nothing but how the option premium is going to move. So how much sensitive that particular stock options are going to move. All those things you can look into. Okay, so yeah, recordings I'm planning to keep this video open. Okay, so you can even watch that from the like from our YouTube channel itself. Okay, so option Greeks, so the first thing in option Greek is delta. Okay, so delta is nothing but how much the particular strike price premium is going to move as per the underlying stock price movement. Okay, so it defines the change in price of an option respect to its underlying stock price movement. So which means that for example the 13,500 call option, okay, let's assume that it's having a delta of 0.50. Okay, so which means if Nifty is moving 1 rupee, then this 13,500 call option will move 50 paise. Okay, so this is about an delta. Okay, so if we say this delta is having an 0.30, then for every 1 rupee movement this option premium will move 30 paise on the upside. Okay, so if there is an one side downside movement, then what will happen is this 13,500 call option will start losing 50 paise from its premium. Okay, so this is about a call option. If in the same way in the put option, uh, also, if the delta is about 50 paise, then if the stock starts moving upside for every 1 rupee, that particular option premium will lose 50 paise, or if the stock starts moving down, then the put options which is having a 50 paise delta will start increase 50 paise for every 1 rupee premium. Okay, so this is about an delta. Okay, so just the simple term about an delta. Okay, so the ATM delta, which is at the money delta, will be having an delta of 0.50, and the in the money delta will always have an higher higher delta. Okay, so that will be from 0.50 to delta till 1, so that will be an in the money. And OTM delta will be having a delta of lower. Okay, so which means it will be having a delta of 0.50 till 0. Okay, so 0.50 sorry, 0.454030, 0.20. So these are all the delta of OTM options. So this is common for both call and put options. Okay, so any doubts in this delta? Any doubts, friends? Yeah, okay, sure. Okay, so this is about an delta. Okay, so if you look at the gamma, right, so delta is not a constant value, so it will keep on changing. Okay, so let's say for example OTM, let's say the OTM option is option strike price is having a delta of 0.30 or 0.40 something else. Okay, so if the stock price starts moving and if that OTM option come as an ATM, right, which is an at the money, so then the delta will be around 0.50. Okay, so which means that the delta is not a constant value. Okay, so it will be going to change as per the stock price movement. Okay, so how much this particular delta is going to move. Okay, so that is defined from an gamma. Okay, so gamma is defines the rate of change of delta with respect to its underlying stock price movement. Okay, so if you want to know, okay, I'll go by a little bit slower. Okay, okay, so if you want to have a deep knowledge about an option Greeks, then I would recommend you guys to request you guys to go through my previous videos where I have made a individual video for an option Greeks alone. Okay, so where I have mentioned deep deep knowledge on delta, gamma, theta, volatility, all those things. Okay, so you guys can go through that videos as well. Okay, so this is about an gamma. So how much the delta value is going to change for every 1 rupee every 1 rupee movement in an underlying stock. Okay, so that is defined from gamma. Okay, and if you look at a theta, okay, so it defines the time decay of a particular strike price option premium if everything remains same. Okay, so here we have seen the OTM options, or all the options prices are the combination of both intrinsic value as well as in time value, right? So this theta will tells us how much that particular stock time value is going to get decayed for every day. Okay, so let's say Nifty is trading at 13,500 and you have an 13,500 call option, and if it, let's say for example, it's have a theta value of 200, then which means that if Nifty doesn't move anywhere and if it stays flat and there is no volatility increase or something, nothing happens. Okay, your position will give you and the time value profit of 100 or 200 as per the theta value whatever you have for every 1 day. Okay, so this is about a theta. Okay, and there is something called volatility. Okay, so volatility is nothing but as per the IV, so IV is an implied volatility. Okay, so if IV increases, then the option premium will get increased, and if IV fall, then option premium will start moving down. Okay, so even though the strike price, if the underlying stock is not at all moving anywhere and the stock is staying flat or constant, and if there is an sorry, and if there is an increase in volatility, okay, IV, by default option premiums will start increasing. Okay, so if you are going to do an option buying or option sellings, right, you have to keep an eye on IV as well. If you are going to buy an option, then IV should be having at the lower level. Okay, so only if the IV is low, then you will be going to get the benefit if there is an IV increase. Okay, so if you are buying an option which is having an increased level of an IV, then if there is any sudden fall happened in IV, right, so then what will happen is you will be going to lose your premium just because of an IV fall alone, IV crash, something it will happen. Let's say for example, if there is any major event going to happen in any of the company, let's say for example earnings result have to be going to be declared in next 1 week, what will happen is IV will be getting increase in those stocks, and you should not buy the options at those times, because like option premiums will be trading at a higher level. Sorry. Okay, so the option premium will be available at the higher level, so you cannot buy it. Okay, so it makes sense to sell option at those times. Okay, so this is about an volatility. So any doubts till now for the option Greeks volatility, whatever we have seen? See, if IV is 75, which means that IV is at the higher level only, it's not an lower level. So most probably the trader can prefer an IV of summer, but again I would say you have to look for an IV percentile or IV rank. Okay, so because like if you look for each and every stock, some IV is defined as an lower. So for example, if you look some other stocks, the IV of 30 even is considered as an higher IV. Okay, but for some other stocks, the IV of 60 is considered as an uh, considered as an uh, decreased IV. Okay, so you should look for an IV percentile or IV rank. So again, there is one video available for that topic as well. Okay, you can just go through that, how to define that whether the IV is having a lower or higher. Okay, so before buying that, okay, so you just go through that. But I would say if you're a buyer, right, so you can prefer buying an in the money options. Okay, so because of that will be having lesser time value, and delta of that in the money will be higher, so you can um, you can consider that as an uh, good options to buy. Okay, so if you are purely an option buyer, then it's good to buy and in the money only. Okay, not an OTM, because like probability of OTM coming as an in the money will be little bit lower, so uh, don't do one OTM buy. Okay, until or unless you are making 100% sure on that particular trades trend. Okay, so how to define IV as low or high, that's what I mentioned. Okay, so please go through about that in my previous videos. Okay, so how can we trade in options? See, most probably for a Nifty and Bank Nifty, you can simply prefer watching the India VIX alone. Okay, so if the India VIX is above 25 or something else, so that will be an higher IV. Consider that as market is more volatile, and if the IV in the India VIX is more higher, right? So then the premium also will be higher side. Okay, so for index, you can just prefer the um India VIX alone, but for the stock related thing, you have to look for IV rank or IVP. But I'll choose either IV rank or IVP, and consider either only one thing. Okay, so don't look into both IVP and IVR. Then again, it will make us little bit confusion whether to look for IVP or IVR. Okay, so take either one thing and you can just go through that alone. Okay, so can we trade in option trading? How? So that's what you are looking into. So I'm not sure what you are exactly asking about. Tamilan. Can we trade in option trading? How? Okay, so now let's look into one some basic strategy. Okay, cash secured put. Okay, so what is an cash secured put is nothing but, so cash secured put involves writing a put option, which means writing is nothing but selling a put option. Okay, and keep cash aside to buy stock if our put option expires in the money. Okay, so which means that you will be selling one put options on the downside and keeping a cash ready so that if your uh, stock is expiring as an in the money for that particular option, you will be going to buy the stock. Okay, so let's assume that Reliance is trading at 2000 rupees. Okay, and you are ready to buy Reliance at 1900 only. Okay, so you think that right now Reliance is trading at higher price and you are not ready to buy 2000 rupees, you are not ready to pay 2000 rupees for each stock to buy in Reliance. Okay, so you are ready to buy only if the stock moves below 1900. Okay, so in this case what you have to do is you have to sell 1900 put option. Okay, so the 1900 put option will be trading around 50 rupees, let's say, just for an example. Okay, so if Nifty, sorry, if Reliance moves down to 1900, then what you can do is you can buy stock with the cash you have. Okay, so since this is a cash secured put, okay, so you can, so you have to keep the cash ready for that. Okay, um, sorry. Okay, so if the Nifty, if the Reliance stock fell down to 1900, what you can do is you can just close your sold put option and you can start buying the Reliance stock for your investment purpose. Okay, and if the stock doesn't comes down to that particular level, then what you can do, you can just, you are going to enjoy the premium which is received by selling an 1900 put. Okay, so in this case you will be getting a profit of 50 rupees. Okay, so 50 into the lot size, whatever it is, you are going to get the profit if the stock doesn't comes down to 1900. So in this case you are not taking the stock for your investment, as the stock doesn't reach to your buy price, but if it is doesn't comes to your level, then you will be going to enjoy the premium received. Okay, so that will be the maximum gain. Okay, if the stock doesn't fall down, the premium received by selling put will be your maximum profit. Okay, so by this way you will get a stock at lower price, and if not, then you will be enjoying the premium as your profit without buying the stock. Okay, so this is the option strategy, cash secured put. Okay, so from where can we find out the what's delta, gamma and theta? I'll be showing that after this session gets over. Okay, so I have a separate slide for that as well. Okay, I'll be showing where to look for the theta, gamma, delta, all those things. Okay, so this is about an cash secured put. Okay, so if you want to buy any of the stock at the lower price, you can sell the put option, and if the stock is coming near to that put option, either you can enter into one stock, or if the stock doesn't fall down, what you can do is you'll be going to get the profit by selling that put option, whatever the profit premium you have received. Okay, since without the stock comes below 1900, your 1900 put option will expire as an OTM. Okay, so by this way you will be going to get the profit. Okay, so can we trade in option like intraday in cash market? Yes, you can do the same option trading same like in cash market as an intraday or positional trade as per your own convenience. Okay, you can do the same thing whatever you are doing in the equity, but only thing here is we'll be having an expiry date, so you have to close your trade before the expiry date. That is the only thing. If not, you can do that same like the equity markets. Okay, so this is about a cash secured put. Okay, so here we are not owning any stock, but to own the stock at the lower price we'll be selling on put option. Okay, so there is something called, some other next strategy we are going to look at is the covered call. Okay, so let's assume that you are holding in Reliance from the buy price of 1500. Okay, so let's assume that you have bought the one lot of Reliance at the price of 1500. Okay, so in this case, right now the stock is trading at 2000 and you are not ready to sell the stock at current price, and you are willing to sell it only at the price of 2100 only. Okay, so if the stock doesn't comes to 2100, you are not going to sell it. Okay, so in this case what you have to do is you have to sell one 2000 call option on the higher side. Okay, so which means that if the stock starts moving upside and if the stock reaches 2100, what will happen? So your call option will be like at the money or in the money. Okay, so in this case your stock price also going to move from 1500 to, you will be going to get exit at the level of 2100, which you have thought you are going to sell it only if the stock, you have to sell it if the stock price reaches the 2100. Okay, Okay, so if the stock doesn't reaches 2100, then what you are going to do, you will be going to earn whatever the premium you received by selling this 2100 put option. Okay, so let's assume that you, by selling 2100 you have received 50 rupees as your profit. Okay, and if the Reliance doesn't reach the level of 2100, then the option premium which you have sold 2100 will be your profit. Okay, so by using this method, what you can do is you can generate a monthly income for your holding stocks. Okay, so let's assume you are holding one lot equal amount of shares in the Reliance. So every month just choose 5% or 10% on the higher side call option, and you can start selling 2000 higher side call options. Okay, so for that, if the stock is going to move upside, you can close your holding stocks at the higher price, and if the stock doesn't reach your level, then you can get the monthly rental income from your selling call options. Okay, so how should we buy cash or future? So we cannot do that in the cash or future. Okay, so we have something same like an option itself. Okay, let me show you how to check that. I'll be just opening and showing you how to um, how the option buying or selling looks like. Okay, yeah. See, you can find out lot many things related to these things, right? So if you look, see, this is a trade I have done in the Tata Steel. Okay, so whatever the strike price, so Tata Steel December month contract, okay, and its strike price is 620, and PE, which means that if it is having a symbol PE, which means that this is an put option. Okay, so here I have done some option strategy here. Okay, so here I have sold and I have bought 610 put option, and also I have bought 570 put option. Okay, so this is a lot size. Here you can see the 1700, right? So this is a lot size, and this is how you have to buy or sell. Okay, so here you can see I have sold 620 put option, one lot, which is in 1700. I have bought 1700 Tata Steel 610 put option, and I have bought December month 570 put option, one lot Tata Steel. So now you guys got it. So this is how you have to buy. So same like cash future, if you just look for your trading terminal, search for the trading terminal, let's say Nifty, and type 13500, you will come to know that the option buyings, the list of options available for the 13500. Okay, so type Nifty space 13500. If you want to buy or sell call option, type CE, or look for the PE, which is in put option. Okay, so if there is a symbol of PE, which means put option, and if there is a symbol of CE, which means that call option. Okay, okay, so and now, so this is in two simple strategies. Okay, so if you want to buy the stock at the lower price, you have to sell put option, and if you have to sell your holding stocks on the higher price, then you have to sell call options. Okay, and the important sites to follow. Okay, so opstra.defineedge.com. Okay, so this will help you to look for the various option related data. Yeah, so covered call is nothing, so I'll come back to that sites once again. Okay, so someone asked about an covered call, right? So see, let's assume that you are holding any of the stock which is equal to one lot. Okay, so let's, I just took an example of an Reliance here. Okay, so Reliance you have bought at 1500, and right now let's assume stock is trading at 2000, but you are not ready to close it at 2000. Okay, and you are ready to close this stock only at the price of 2100 rupees. Okay, and if that if the stock doesn't reaches the 2100, then you are going to close your trade. So you are not going to close your trade, and you will be going to hold the trade. Okay, so in this case what you have to do, you have to sell one higher level call option. Okay, so which means that at the price where you are willing to buy, willing to sell it. Okay, so which is 2100 here. Okay, so if you are selling the 2100 call option, what will happen is you will be going to sell that 2100, and you will be going to collect some premium. Okay, if the stock is going to reach 2100, then what you can do is you can close both your 2100 call option as well as your holding stock. And if the price doesn't reach to that level, what you are going to do is you will be going to enjoy the profit whatever you have sold from whatever you have collected from 2100 call option, because the price, stock price doesn't reach 2100. So the 2100 call option will expire worthless, which means that it will expire at zero. Okay, so let's assume you have collected the premium of 50 or 100 or whatever it is. Okay, so you will be getting the profit. So you can generate the monthly income by doing this all the time. Okay, so if the stock is trading at 2000, you can start selling 2100 or 2200 or whatever the price you are comfortable on the higher side. Okay, you can collect the monthly premium. So apart from the investment returns, you will be going to gain some profit by selling these options as well. Okay, so the main motto of an option is to buy insurance, or selling to buy the insurance for your for your holding stocks, or to sell at the predefined level. So all those, only this is the purpose of an option tradings actually. Okay, so but okay, so now hope you got it. Yeah, sure. Okay, so this is about an covered call. Okay, so now these are all the important signs to follow related to an option tradings. Okay, so this is an option opstra.defineedge.com. Okay, so here what you can do is you can look for an option Greeks. Okay, so this is an option chain. So here you can see that option deltas here, right? So if I'll show you some examples. Okay, so right now 13760 is the market price. Okay, so I'll show you 13750 call option. Okay, so if I am buying the 1350 call option, okay, so here you can see that there is some tab called Greeks. Okay, so in this Greeks you will come to know what is a delta, what is theta, what is gamma, and what is vega. Okay, so just click on this Greeks in rupees. Okay, so if you click on this Greeks in rupees, right, you will come to know the delta is 52, which means for every 1 rupee this particular position will give you 52 rupees profit. Okay, so if let's say Nifty is moving from 13760.55 to 13761.55, then this premium will be giving you 52 rupees as your profit. Okay, and this is an theta. Okay, so since you have bought this, okay, so uh, for every day if market is not moving anywhere, you will be going to get the loss of 600 rupees because you have bought. Okay, so this premium will contain both intrinsic value as well as a time value, so you will be going to get the 600 rupees as your loss for every 1 day. if the stock is not moving anywhere. And this is in gamma, so which means for every 1 rupee movement, how much this particular delta is going to move. Okay, so for every 1 rupee, 52.39 into 0.11. Okay, so this is the amount for every 1 rupee it is going to move. So this is about an option Greeks. So this is about an option buying. If you look at an option sellings, right, so it will be exact opposite. Okay, so it will be going to move. So if the market is going to move on the upside, you will be going to get the profit of 52 since you have sold this call option. Okay, and you'll be going to get the profit of 661. Okay, so this is about an option Greek, so where you have to look into an option option Greek values. Okay, so this in this site you can create an sign up using your mail id for free of cost. Okay, and then you can just click on this option and strategy builder, and whatever the option strategy you want to do, you can just simply enter those values here, and you can look for the payoff graph. Okay, so let's say you are buying one 13750 call option. Okay, so then what you are doing is you will be selling one 13850 850 call option as well. Okay, so in this case what will happen is, okay, so here you can see this is the payoff graph. Okay, if the market is going to move upside, you will be going to get the maximum profit of 3758. Okay, and if the market is going to move down, and wherever the market goes, you will be going to get the loss of 3750 rupees, and your break even is 13800, which means if the stock starts moving above 13800, you will be in the profit, and the margin required for this will be only 20,000. Okay, so you can start doing multiple strategies here. Okay, so you can just do the paper trades as well here. Okay, so if you look at, so this is an option buying payoff graph. Okay, call option buying payoff graph. If the market is keep on moving down, I'm not going to lose more than 11,000. But if the market, let's say for example, if before this expiry, if market goes to 14,600, my profit will be 56,000. Okay, if you're an option seller, okay, so your maximum profit will be only 11,700. Okay, you're not going to get profit more than 11,700. Okay, so this is the amount you have got credited by selling this 156. But if the stock starts moving upside, right, what will happen if market goes to 14,500, 600, wherever, you can see here your loss amount will keep on increase. Okay, you can also see your max loss is undefined. You'll be going to get the maximum loss if the trade goes against you. Okay, so someone asked about the hedging, right? So that is the use of an hedging. So you have sold 13,750 and you are worried about the upside moment. Okay, in this case what you can do is you can just buy one 13,850. Okay, so if you are buying one 13,850, now you can see that, so this your maximum profit will be only 3,700, but also your maximum loss will be only 3,758. Okay, so this is about an hedging. Okay, so simply you have to hedge your position, which means you have to maintain one buy for every sell, so that you can avoid something. If something bad happens, you can avoid the unlimited losses and you can limit your losses. Okay, that is an option hedgings. Okay, yeah, so this is about an upstart define edge, and same thing, the option related things you can look at from an quants app as well. Okay, so if you look at the quants app, so this is an android application. I'm not sure how about it's having its app on apple or not. Okay, so I'm an android user. Okay, so there quants app is available. Okay, so again there you can look into an option related data, the option chain, all those things. Okay, and trading view, where you can get multiple trading ideas and chart related stuffs. Okay, and money control and economic times you can follow for an market related news. Okay, and stock edge you can use it for an technical scanners and bulk deals, so where lots number of people are getting all those things. Okay, so this is an important sites to follow. Okay, and these are all the different blog sites I personally maintaining this. Okay, so my YouTube channel is Let's Learn Trading, where till now I have posted around more than 85 videos. Okay, so purely that's belong to an option tradings only most of the time. Okay, and also there is some option Greeks, how to pick up a stock based on the technical analysis. All those things you can go through from this YouTube channel. And for an option related stuffs, I'll be writing in this blog on the daily basis. Okay, so I'll be writing and posting two posts every day on the market opening days around 9 to 9:30 a.m. Okay, so you can go through that from my blog. And if you want to look at the various services we provide, okay, what you can do is you guys can just go through my website. Okay, so which is www.letslearntrading.com. Okay, and I'll be posting a lot many my trading ideas, my how I am doing the adjustments to my existing trades, and how I am picking the stocks. All those things I'll be posting in my Twitter, and this is my Telegram channel as well. Okay, so where I'll be um, posting my telegram learning related charts, all those things in my telegrams as well. Okay, so here you can see that. Okay, so till now with a capital of around 4.5 lakh. Okay, so till date the returns achieved in this particular strategy is like around 3.5, sorry, 34,000. Okay, so you guys can just go through this blogs on the for your learning purpose. Okay, and this is the also I conduct some paid webinars as well. Okay, so on the every weekends I'm keeping in paid webinars. Okay, so you can just go through the topics covered. So how we have to identify the trade, the stock option strategy, how to do the adjustments, how we can execute the trades in the index, and how to enter and exit, and question and all those things. Okay, so here you can also come to know our few profit and loss from my previous attendees, as well as an feedback from them. Okay, so if you're interested, you can also you can find out my WhatsApp number here. Okay, so you can ping me one to one. Okay, yes, so tell me, Sivaga. Okay, so in intraday is IV also affect in option premium, because sometime I saw if spot move with high volume, then premium move above as delta value. Can you explain please? Yes, so even in the intraday also, if the IV is moving up or down, as per that the premium is going to move. Okay, so it doesn't know, the market doesn't know whether the trader is doing intraday or the positional trades, right? So as per the IV's movement, there will be an premium increase or decrease as per the IV movement as well. Okay, let's say for example, if you look at the last week, right, last week or 2 weeks back, I'm not sure when it happens. So the IV India week started moving down very drastically 2 weeks back, I hope. Okay, so in that time if you see, all the option buyers, right, started losing premium very fastly, because due to an India week started moving down. So there is an option premium start moved very faster on the downside. Okay, so that will happen in the downside as well. Upstra 1 sigma 2 sigma, what's that, I'm not sure about that. So just go through. So this is the website, upstra.defineedge.com. Okay, so this site will help you. I'm not sure what you are exactly asking about, Napster 1 sigma 2 sigma. Okay, so if you guys are interested to learn more about an option strategies adjustments as well, okay, you can go through these things, and you can also ping me personally to my WhatsApp as well. Okay, and I'm planning to keep this video open, okay, to all in a public forums only. Okay, so you guys can revisit this same video if you guys have any doubts in the futures as well. Okay, so you guys can note down all those IDs, and you can just follow me wherever if you are possible. Okay, and thanks for watching. Okay, and please do subscribe to our channel, and I have completed the sessions now. Okay, and I'll be keeping this um, keeping this for I'll be waiting for 2 more minutes. Okay, if you guys have any doubts you can ask me now. Okay, so here you can see that, so I have posted lot many videos. Okay, so if you look at how to do an adjustment if the market is too bullish, or how I made the profit of 18,000 in the last 1 week alone. Okay, so Nifty option strategy for in December. So the new option trading series, how to do an option sellings uh, in the downside. So lot many options adjustments. Okay, so Nifty expiry day trading strategies. Okay, so how to adjust your short straddle, short strangle. So all what is in multiple different option strategies like bear call spread, bear put spread, bull call spread, bull put spread, short CE adjustments. Okay, and even how to get the monthly income strategies like okay Nifty income monthly strategies, how to earn a consistent profits. So all those things are available in our videos. Okay, you can find out all the videos here and you can go through that. Okay, so if you guys have any doubts you can just WhatsApp me as well, and if you guys are interested in our paid webinars also, you can just go through my blog and the sites, and you can take a decision if you guys are purely interested. Okay, so this is not any anything. Okay, so and you can also check that. Okay, so this is purely my paid webinar is only I have kept an affordable price, and only a limited number of people will be available, will be allowed to our sessions. Okay, only because I have to keep that session more interactive. Okay, so that is the reason I don't allow much people, and the price is very affordable prices only. Okay, so hope you guys have enjoyed my video. Okay, and thanks everyone once again. Okay, so I'll be disconnecting now. Okay, so thanks for watching friends, and all the best for your future. Thank you. So kindly explain about stop loss if you are buyer and seller, and I want to stop loss in premium. Okay, so stop loss is purely based on one trader's risk appetite, I would say. Okay, so let's say what I will do is I'll be doing an adjustments instead of taking in stop loss. Okay, um, so Shivasakti Maneguran, I'm not getting you what you are trying to say to me. Okay, so if you still have any doubts, what you can do is you can just take my mobile number from my YouTube channel or from my website, and you can just message me. Okay, message or call, whatever as per your convenient. Okay, so I'm not sure what exactly you're asking about. Okay. Okay, so the stop loss to answer Deepak's question, right? So that is the stop loss. You have to keep it as per your own convenient, I would say, but always make sure that you come out of the trade if there is something bad happens really. Okay, so just keep a stop loss like around 5%, 10% as per your own risk. Okay, and thanks Vasu for your golden words. Okay, so thanks everyone. All the best. Thank you.